What if I told you the single greatest investing book ever written? Doesn't promise quick riches, doesn't sell a secret formula, and doesn't even try to predict the market. That book is Benjamin Graham's The Intelligent Investor. First published in 1949, it's still a bestseller more than 70 years later. Warren Buffett read it at 19 and said it changed his life forever. He calls it, by far, the best book on investing ever written. And he built his entire strategy on its lessons. Here's the twist. This book isn't about outsmarting Wall Street traders. It's about how to ignore the noise, control your emotions, and build wealth the slow, safe, intelligent way. And today, we're breaking down the 5 most powerful takeaways, the same 5 ideas that turned Warren Buffett into a billionaire and can help you protect and grow your own wealth. But here's the real question. If these lessons worked for Buffett, what could they do for your financial future if you started applying them today? Takeaway 1. Meet Mr. Market. Imagine you own a small neighborhood barbershop. Every morning, your eccentric neighbor, let's call him Mr. Market, barges in with a new offer. Day 1, he's buzzing, "Barbershops are the next gold mine. I'll pay you $1 million for this place." Next morning, he's sulking. "Haircuts are out. Nobody cares anymore. I'll give you 50,000 tops." Day after that, he flips again. "Actually, I've changed my mind. How about 700,000? Would you take him seriously?" Of course not. You'd keep cutting hair and serving your regulars. But here's the tragedy. In the stock market, most people do take Mr. Market seriously. They panic when he's fearful, and they chase him when he's euphoric. Benjamin Graham's point is simple. Mr. Market is not your master. He's your servant. When he's scared, that's when bargains appear. When he's greedy, that's when risk is highest. And on most days, the smartest move is to ignore him completely. Warren Buffett loves this lesson. He often says, "The market is there to serve you, not to instruct you." And he warns that if you can't handle seeing your portfolio drop 50% without panic, you probably shouldn't own stocks at all. Think back to March 2020. Microsoft, Apple, Amazon. Their stock prices crashed in weeks, even though their businesses were still thriving. That wasn't reality changing. That was Mr. Market having a meltdown. In the short run, the market is a voting machine, swayed by moods and noise. In the long run, it's a weighing machine. True value gets measured. So here's the mindset shift. Your job isn't to predict Mr. Market's moods, but to know the value of what you own, and act only when his price gives you the advantage. The question is, will you let Mr. Market's moods control you, or will you finally use them to your advantage? Takeaway 2. Investment versus speculation. Here's a hard truth. Most people think they're investing, but really they're just speculating. Investing is like buying a duplex you actually plan to rent out. You check the roof, you check the tenants, you check the neighborhood. You know it'll generate steady rent for years, and you're fine holding it long term. Speculating is like buying that same duplex just because your cousin swears the price will jump next month. You don't know the tenants. You don't care about the upkeep. You're just hoping someone else will pay more than you did. Benjamin Graham drew the line sharply. An investment is one that, after careful analysis, protects your principal and provides an adequate return. Everything else is speculation. That's it. Simple, but powerful. Think back to the dot-com bubble. Investors threw money at anything with .com in its name. Many of those companies had no profits. Some didn't even have revenue. That wasn't investing, that was gambling dressed up as strategy. And history keeps repeating meme stocks, crypto hype, or can't lose tips from social media. People aren't buying businesses, they're buying hope. Buffett took Graham's lesson to heart. That's why he only buys when he understands the business inside and out. It's why he invested in Coca-Cola in the 1980s. Not for a quick flip, but because he knew billions of people would keep drinking Coke for generations. Next time you're tempted by a hot stock, ask yourself, am I truly investing or just speculating? Takeaway 3. Margin of safety. This is Graham's most famous idea, and Buffett calls it the cornerstone of intelligent investing. Imagine you're building a bridge that needs to carry 10,000 pounds. Would you design it for exactly 10,000? Of course not. You'd make it strong enough to handle 30,000, just in case. That extra strength is your margin of safety. In investing, it means never paying full price for a stock. If your analysis says a company is worth $50 per share, you don't buy at 50. You don't even buy at 45. You wait until it's closer to 30. That cushion protects you when things inevitably go wrong, and things always go wrong. Economies stumble. Businesses miss earnings. Markets panic for no reason at all. Your margin of safety turns those storms into opportunities instead of disasters. Buffett has lived this principle for decades. In 1973, he bought shares of the Washington Post at roughly 25 cents on the dollar. That $10 million investment grew into over $1 billion. The margin of safety gave him protection on the downside, and enormous upside as value caught up. The same was true in 2008. While fear was driving prices into the ground, Buffett was quietly buying Coca-Cola, American Express, and Johnson & Johnson, businesses trading far below their real worth. Here's the golden rule: a great business at the wrong price is still a bad investment. That's why patience is part of the margin. Don't chase. Don't let FOMO trick you. Wait for your pitch. Or, as Buffett says, the stock market is designed to transfer money from the impatient to the patient. Have you ever overpaid for something, a car, a gadget, maybe even a stock, and regretted it later? That's exactly what Graham's margin of safety is designed to prevent. Takeaway 4. Defensive versus enterprising investors. Here's where Graham gets brutally practical. He says there are only two kinds of investors: defensive and enterprising. The defensive investor is like a careful driver in a reliable car. They want simple, steady results. No speeding, no stunts, just getting to their destination safely. For them, the strategy is boring but powerful. Buy broad index funds, maybe add some bonds, invest consistently every month, and rebalance once or twice a year. That's it. The enterprising investor is more like a race car driver. They love the thrill of the hunt, study every detail, and put in the hours to master the track. In investing terms, that means reading financial statements, digging for bargains, and working hard to find mispriced stocks. It takes time, discipline, and serious effort. And most people aren't built for it. What Graham warns against is the in-between driver, the person who doesn't put in the work but still takes big risks. That's where crashes happen. Buffett started as an enterprising investor, reading annual reports for fun, visiting Geico in person to understand its business, and buying companies when they traded below their true value. Over time, he evolved to focus on buying wonderful businesses and holding them for decades. But the foundation was pure Graham. So ask yourself, are you the careful commuter or the race car driver? Both can work. But trying to drift in the middle is how portfolios and dreams get wrecked. Takeaway 5. Master your emotions. Here's the hardest lesson of all. Graham wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself. It's not the Fed. It's not recessions. It's your emotions. When markets fall, fear whispers, 'Sell before you lose everything.' When markets soar, greed screams, 'Buy now before you miss out.' That's how fortunes are lost. Think of emotions like turbulence on a flight. A rookie pilot panics and jerks the controls. A professional trusts the system, stays calm, and rides it out. The intelligent investor does the same. They know volatility is normal, even healthy. They follow a plan: dollar-cost averaging, rebalancing, sticking to their allocation, ignoring the drama. Buffett has lived this for decades. He's watched crashes, bubbles, entire sectors collapse, and he keeps repeating the same mantra: be fearful when others are greedy, and greedy when others are fearful. That's what Graham meant by intelligent. Not IQ points, but discipline. The next time the market swings, will you be the calm pilot or the panicked rookie? So let's bring it all together. Number 1, Mr. Market is emotional. Use his moods, don't obey them. Number 2, investment versus speculation. Know the difference, or the market will punish you. Number 3, margin of safety. Always demand a cushion between price and value. Number 4, Defensive versus enterprising. Pick your lane, commit, and stay consistent. Number 5. Emotional discipline. Master yourself, or the market will master you. 5 timeless rules. They turned a 19-year-old Warren Buffett into a future billionaire, and they can still guide you today. But here's the real test. It's not whether you know these rules. It's whether you'll live by them when fear and greed take over. So tell me, which takeaway hits you hardest right now? And more importantly, how will you apply it this week? Drop your answer in the comments. Your story might help someone else watching. And if this breakdown helped, hit that like button and make sure you subscribe so you don't miss the next big idea we unpack. This is Mindcraft, where ideas become action, and action becomes your future.